The stock market and the interest rate market, they're just on such different paths right now. Welcome investors, and thanks for joining us on your Investment Advisor channel, where we decipher the markets so you can make actionable investment steps. I'm Jake Ackerman. U.S. debt's downgraded. The jobs market gives us mixed data, and the bonds/interest rate market and the stock market are just on completely different pages. We got a lot to cover, so let's just get right into it. So I want to put on your screen here, let's touch base first on the Fitch downgrade of the U.S. debt. So on Tuesday, Fitch downgraded the U.S. debt from a AAA to a AA+ rating, and they're citing the handling of the debt crisis 2 months ago, deteriorating finances, and express major doubts about the government's ability to tackle the growing debt burden because of sharp political division. Is that going to change with this interest rate raising campaign? Is this going to change the economic outcome of what we have going on currently, where we're seeing kind of a rebound in strong jobs markets, a continued economic activity? Granted, it's definitely slowing down. Is this downgrade really going to change the whole dynamics? Domestically, probably not. Internationally, with Japan, China, EU countries, UK buying U.S. debt because of the downgrade, is it going to have ramifications? Yeah, that definitely could, because now the U.S. has to pay a higher interest rates on our debt, potentially. Now, the internal domestic monetary policy is going to affect what the other countries are going to get in interest rates. So this totally might have zero ramifications, because the federal government, the Fed, who's controlling monetary policy with their interest rate raising campaign, really can dictate what our terms of our rates are going to be. They can control the short end of the short end interest rates, and they can control longer term interest rates. So does this downgrade have a major effect? Again, probably not. Could it temporarily, on a short term basis? Yes. But I think we're going to really move past that here shortly, and it's going to be a thing in the past. Are we going to experience some volatility? We've already have since that downgrade. So now let's shift on to things that are probably more important in the short term and over the next couple of years, and definitely in the near term, over the next 6 to 12 months. And it's going to be two things that we need to keep in mind. And this is all around the Fed, because the Fed's rate raising campaign is controlling the economic activity. The higher the interest rates, the tighter monetary policy is, the harder it is to get credit, to operate your business, to get loans, to go out and spend. So with them raising rates, with keeping two things in mind: that inflation data, CPI, PCE, producer price index, other inflationary metrics, and the jobs market. Because we've had inflation continuously coming down since June of last year, 2022, and they've still been raising rates. And that's because they have an excuse. Hey, job market's strong, the economy's doing well, stock market's doing well, real estate prices are still high, so we need to continue to raise rates even though our inflation is coming down. And that's because generally markets don't move in a straight line. They'll have ups and downs, but right now the path is down, that we absolutely can have a little spike, and they don't want any spikes. As long as the job market remains strong, they have their excuse to keep raising rates. So let's get into two data points that we've seen this week, and again, they're mixed. So the first one I have on your screen here is non-farm payroll, and that's private sector jobs and public sector jobs minus farm. And the consensus was 200,000 new jobs. Well, what did we get? We got 187,000, so slightly lower than expected. Now let's move on to the ADP employment report, which is this one's specifically focused on private sector. ADP is a separate company. The non-farm payroll is by a government report. ADP, the median forecast was 175,000, and 324,000 came in. That was quite a bit higher than expected. So that's telling us the job market's mixed, and the public and private combined was just different than ADP had their own report, and how they calculate their metrics are slightly different. So we're still seeing a strong job market, but in non-farm payroll, this is the first kind of coming in lower than expected that we've seen. So that's saying that there could be signs of the job market cracking a little bit. And that that again could give the Fed the excuse not to raise rates if the job markets it starts to tick up. If unemployment starts to rise, if things get worse in the job market, they're going to be forced to no longer raise rates. But right now, jobs are still strong. Granted, yeah, it came in lower than the non-farm payroll came in lower than the forecast, but again, still strong. And that ramifications is still leading into the stock market. So I want to touch base on the next thing is why the stock market and the interest rate market, they're just on such different paths right now. So you got stock markets, you got companies making new highs, everything's good. Let me show this real quick for you on your screen. This is the next Fed meetings in September here. What I'm showing you here is the expectations of another rate hike. And right now you can see on your screen is the market believes, as of today, that there's an 86.5% probability that the Fed is not going to raise rates in the next September meeting. So the stock market is just why it's going up. They don't think the Fed is going to raise rates, even though the Fed said, it's kind of a 50-50 flip of a coin. Maybe we do, maybe we don't. With a strong jobs numbers and inflation, the possibility of it ticking back up, they're probably going to err on the side of let's keep raising rates. Now, granted, we have a whole rest of this month worth of inflation data in August, and then we still have a couple before the Fed meeting in September. We also have the same jobs numbers going to be next month in September. So we're going to have more data going into that. So we need to be flexible on our positioning. And right now, stock markets at all-time high are getting closer to all-time highs. You have stocks making all-time highs. There's a lot of fear of missing out. There's a lot of greed in the markets right now. So, as professional investors, do we always want to follow the herd? You already know the answer to that. So again, the stock market believes, hey, there's no chance of the Fed's not raising rates. There's a high probability. Now, what is the bond and interest rate markets telling us? Let me pull up the 30-year fixed mortgage interest rate to highlight that for you. And what you can see there is, the interest rate market is ticking back up to its end of year November timeframe interest rate high, despite inflation coming down. And when the interest rates are going up, bond prices are going down. Who are bond investors? Your institutions, your banks, your government agencies, your insiders all invest in the bond market. And so as professional investment advisors, my preferred metric and our team's preferred metric is to really focus on the bond market. They generally are less emotional. They have more information. They're the insiders. They control all the money. So we watch them. So what's this telling us? That the bond market thinks that they're absolutely going to raise rates. That's why the bond market's coming down. Interest rates are going up. They have this reverse seesaw kind of a deal. And those are the ones that we're monitoring. So they're on different pages. Bond market's saying rate hikes, stock market's saying nothing. We're going to err on the side of what's the bond market telling us right now, and we are making our positioning. So that's where we're going to park our money and look for a potential rate raise later. So you have, again, these two differences. And what's another thing that potentially could throw a wrench into this and bring inflation data back up? Commodity prices. What's going on in the commodities market? Commodities, and one I like to highlight that's just everywhere, and that's crude oil, energy prices. Even though some of the inflation data they use gets rid of energy prices and food prices because they're more volatile, more ups and downs. But I tell you what, crude oil, which leads to gasoline, with manufacturing, it is in everything. And just because you can exclude the actual price, can you exclude the ramifications from higher energy costs? I know when you guys are driving to work, you guys and gals driving to work, that you notice when the cost of gasoline goes up. When you're driving, you want to take your family on a trip, when you're going to pick up food, groceries. It has direct correlation to the cost of all kinds of products because you have to transport them by plane, by railroad, by car, or truck, van, you name it. It's going to have ramifications across the board on how prices either go up or they go down. Higher energy costs means prices go up, lower energy prices go down. So what's been going on this last month with energy prices? Let's take a quick look. So we can see Energy prices this last month is up 11.85%. In the last 3 months, up 15.52%. So we can see energy prices ticking back up. Again, so what's the conclusion to this? That more likely than not right now, even though the stock market isn't in agreement with the bond market, that rate raises are more likely than not, even though the market doesn't believe so, because there's divergences. We're trusting the bond market. They've been right much more frequently than the stock market. They're the institutions, they're the insiders. Energy prices are ticking back up. That gives Fed even more cover to want to raise rates. But again, more data coming in. If jobs numbers start to show a crack, unemployment sticks up, they no longer have this excuse unless inflation starts ticking back up, and then we'll have to see what happens. So stay flexible, folks. If you got some value from this page, do me a favor, like and subscribe, and join us next week. Well, we'll decipher the markets so you can make actionable investment steps. Expertise you deserve, experience you can count on.